Welcome to this video on understanding order types. What's the difference between them all? In this video, we'll talk about how does the market work, the market order, the limit order, the stop market, the stop limit, the trailing stop, and order timing. Let me know if you have any questions on any other order types. So, how does the market work? People submit orders to buy and sell. These orders create an order book for each instrument. They're grouped into buy and sell orders, and the orders are sorted from lowest to highest price. The highest buy price is called the bid. The lowest sell price is called the ask. The difference between the bid and ask is called the spread. This is how we can represent it. We've got all the buy orders, sorted from lowest to highest, and the highest buy order is the bid in the blue there. All the sell orders, which are of course higher priced than the buy orders, are also grouped from lowest to highest, and the lowest one is the ask. Let's look at this again. So what happens to new orders? If a new buy order is lower than the current bid, it is inserted into the group and it just takes its place. If a new buy order is higher than the current bid but lower than the ask, it becomes the new bid. If a new buy order is higher than or equal to the current ask, then it will match and a sale will be made. On the sale side, if a new sale order is higher than the current ask, it gets inserted into the group. If a new sale order is lower than the current ask but higher than the bid, it becomes the new ask. And if a new sale order is lower than or equal to the current bid, again, a match will be made and the sale will happen. So, the market order. A market order will use whatever price is currently being offered. You don't specify a price, you just say you want to buy or sell. If you're buying, you'll get the lowest price someone is willing to sell for right now, which is the ask price. If you're selling, you will get the highest price someone is willing to pay right now, which would be the bid. If the spread is large, there can be a big difference between those prices. The advantage of the market order is that the order will generally be executed very quickly, assuming there's liquidity. The downside is that you're not sure what price you'll get. You may not end up with the ask or bid that you see when you submit the order, as these numbers are constantly changing. The limit order. When entering a limit order, you specify the worst price you're willing to accept. So if you're buying, it should be a price lower than the ask, and you won't pay more than the limit. If you're selling, it should be a price higher than the bid, and you won't receive less than the limit. A limit order may not execute if no one is willing to meet your price. The advantage of the limit order is you have better control over the price than the market order. The downside is that the order might not be executed. It is possible that a limit order is executed right away, but if it's not, it will be added to the order book. The stop market. So a stop market order has a stop price. If the market meets the stop price, your order turns into a market order. If the stop price is not met, the order will not be activated. And you can do this as a protective order to limit a loss or to protect a gain if the price drops on a stock you own. This would be a sell order. But you could also do this to buy a stock if there's a drop in the price that you might want to take advantage of. Note that the actual price you get may be quite different from the stop price, because it'll just be a market order, and if it dropped way below your stop price, then you'll get whatever that happens. But this seems to be similar to the limit order, but the difference is that there's no price guarantee. The stop limit. So the stop limit order is similar to the stop market order. The difference is that when activated, it turns into a limit order. So when you create that order, you specify the stop price and also the limit price. The limit order may not execute if no one's willing to meet your price. You can specify whatever limit price you want. It can be above, below, or even the same as the stop price. Next is the trailing stop. You can use a trailing stop order to try and get a better price if the market is moving in a favorable direction for you. You want to sell, but the market is trending up, so you want to get the highest you can. Or you want to buy, but the market is trending down, so you don't want to buy too soon. You want to keep going down and buy at the bottom, hopefully. The trailing stop has a parameter, which is a price differential. This can be a direct unit price, or it could be a percentage of the value of the price. And this differential is used to define a stop price. If the market meets the stop price, then your order turns into a market order. But as the market moves favorably, the stop price moves with it. That's different than just a stop order. So let's see what this looks like. Let's assume that this line represents the price of the stock from lowest to highest. And the blue line represents the current price, and the red line is the stop price, which has been calculated by the differential specified. As the current price decreases, it pulls the stop price with it. Both lines move over to the left, and the distance between them stays the same. When the current price increases, so the blue line moves to the right, it gets closer to the stop price, but the stop price does not move. So it can only be pulled down. When the current price reaches or passes the stop price, the trailing stop is activated as a market order. Note that if the market moves in the wrong direction right away, you'll generally end up paying more because you'll pay, instead of paying the market price, you'll pay the stop price, which is always higher in the case you're buying. So for this reason, you don't want to make the price differential too small so that it gets activated by a small increase and decrease. If the stock's going up and down by small amounts, you'd probably want your price differential to be bigger than that, so it would ignore those in the hopes that then you'll go back down. Order timing. So order timing refers to how long an order stays in effect or even enters, becomes active. Common timings are day. So this means normal market hours from 9:30 a.m. until the end of trading day at 4 p.m. Eastern. And it will not execute during pre or after market hours. Day plus extended hours means that it will include those extended hours. Whether you're pre-market or during the market, it could still execute after the market closes. GTC, or good till canceled, is the order will basically stay active forever until you cancel it, but it will only be active during normal market hours, so 9:30 a.m. to 4 p.m. Eastern generally. If the price that you specify becomes active after 4 p.m., it will not execute. GTC plus extended hours will let it do that. So what's the difference? Generally, extended hours, there's not as many people trading, and the prices may be a little strange, or you could get a much lower price for a little bit and go back up. So generally not good idea to have a GTC plus extended hours if you're not certain that that's the price that you would really accept. Extended hours AM just means between 8 a.m. and 9:30 in the morning, so the pre-market hours. Extended hours PM means between 4 p.m. and 10 p.m., and it would only be valid then. So thanks for watching. Let me know if you liked this video or have any questions or topics you would like to hear about.